All right. Welcome aboard. So I've been doing these weekly webinars, weekly roundup is what I call them, for about 3 months now. And what I try to do is I try to get through some major, macro stuff, some market psychology, and then some seasonality things, and then dive into some major, movement predictions for a couple of different asset classes, mostly just stock indices around the world, kind of heavily focused on the U.S. markets, and then get into other things like commodities and currencies, and a few other things. So usually I like to start off with the S&P 500 because that's just a great place to start. And over the last couple of weeks, I've been talking about how we are in a Fed bond buying program, and the psychology of what we're dealing with has been really interesting to watch. People calling for tops, people calling for bottoms, people calling for whatever. And since we're still in this Treasury and MBS buying program from the Fed, I really have to go with what the Fed is saying. And what the last direction was on Wednesday was we're not even thinking about raising rates. So I'm not even thinking about a top right now. And everything that the S&P 500 is actually showing is that, we're still going up. And any attempt to really short since the June FOMC back here really didn't work out so well going forward in time. So, it's really hard for me to call a top during this time when that is what's happening in the background, because I'm going to show in this video, I'm going to get into things about what has happened during previous QE cycles and why it is important to go with the Fed as long as possible for as long as the music lasts. We all know that there's some serious problems with the economies around the world, and the U.S. is no exception to that. But while the music lasts, we have to play along because shorting the market is very dangerous right now. So what I can definitely go into is what I like to look at is first the S&P 500, and then I look at probably some of these SPY blocks that I like to look at. So over the past couple of weeks, we have gone in and out of some very important dark pool levels. And back on that June FOMC that was right around this area, that was a big short for two reasons. One, this huge February 21 gap area, which is a Friday, and then the open, which is where the bottom of this rectangle is, was the following Monday. Went right up to that, and professionals love to take the markets up to a big gap like that and pause right before filling the gap at the previous close, which would be this February 21 close back here, and then drop it down. And it also happened to be right where this previous huge dark pool level from December 20th last year. And a dark pool level, what that means is that there were 40 million in block trades from the previous session on December 19th that showed up the next day on December 20th in excess of 40 million. And we've actually added to this over time because there's been several dark pool levels of previous closes around as we've been juggling this line and dancing around it for the last couple of weeks now. So that last short was one of the best shorts that we took for this island top that's no longer an island top because we overcame it and filled this gap. But this was the June FOMC right here, and then we dumped down to this other gigantic block level that was from back in February when we were on our way down. And there was a huge level that we actually moved back up from before actually going down even more until we finally found the bottom in March. So one of the big things that I've been talking about is whether or not we are obeying normal election year seasonality, which I have in the background here, and the performance is shown in teal, which is actually fitted. It doesn't really look like this. It's not. This is saying somewhere over negative 1.5, but I have this fitted. It's the performance is actually fitted so that we can see the peaks and valleys of the seasonality profile. So what this is actually showing is the seasonality profile for the last 10 years, and the thick yellow line is what we have already accomplished. The remaining little dots is what the expected performance is based on the average of the last 10 years, so 2010 to 2019. And usually there is a big top around the FOMC that happens in late July, early August. And you can see that one of the reasons when I programmed this, when I created this indicator on TradingView, for any ticker, that's what the great thing about it is. You can do any ticker. You can also do a combination or a formula like DJI divided by SPX or something like that, which I definitely do to do exotic spreads in commodities and in equities. And one of the things that you quickly become aware of is the fact that the indicator has the last 30 years of FOMC dates, and big relative tops and bottoms seem to occur on FOMC dates. And one of the common themes is buying into the FOMC, which is a buy the rumor, and then the selling after the FOMC, which is a sell the news event. And that's exactly what happens if you can look at the actual up until about March, we were doing the complete opposite of the profile, obviously. This says going up. We went down heavily into March. But after that, we've kind of had these realignment moments. And I just say realignment, meaning that, the big June top was a huge retail, rally that they killed the rally. They made in the gray bars in the background, you can see that DJI went parabolic, and there was just no way it was sustainable. Combined with the FOMC, it was a no-brainer to short that. It was not sustainable. So this big area right here on June 25th, June 26th was a big buying time to go long the market, and that's exactly what we actually did. In the trading group, we all talked about it live to actually go in the markets long during that time based on this seasonality long, and I'll get into a little bit more on why that was actually a good time. But normal seasonality says for the last 10 years, on average, this late July, early August FOMC is actually a sell the news date, and it's actually a decent one. And we descend for about 2, 3, or 4 weeks into late August, and then gradually buy back into the next FOMC date, which is on September 16th. So it's a common theme. And then, have some moving around here towards the election. However, there's a filter on this where you can set election years or pre-election years or midterm years, and this is an election year. Election years has this peculiar performance that's the exact opposite for this time of year. There's actually a buying into the Fed and continuation all the way to the next FOMC statement that same date. So all of August basically to this September 2nd to 4th top, somewhere around there is a top. But both agreed that there is a June 26th on average bottom, which is exactly where we bottomed right here on these gray candles in the background. So both of those confluence zones gave credence to us going long stocks during that time. And then a big top somewhere around here for a sell-off into October. And what is interesting about this is that if you go to VIXCentral.com, www.VIXCentral.com, it shows the current VIX futures contracts going up to October. And remember that this shows a top somewhere around September and then a selling off into October before the election. So keep that in mind. Right now we are in deep contango, meaning that the futures are all very far above the VIX spot price of 24 something. So the contango that it's showing is 10 point something percent. What that means is on average VXX, the symbol VXX, has to descend about 0.33% per day because of the decay for futures to be equal to the spot price by the time they reach expiration. In order for that to happen, so VXX is a linear combination of the first two VIX futures contracts. So right now it's the August and the September. This August contract expires in 18 days, and it has to, by the nature of futures or options or anything like that, it has to expel all of the extrinsic value by the time it gets to the expiration date on the 18th. So that means if VIX held at this current level, this VIX future must reach $24.46 by the time it's the 18th, which is in 16 days. So on average, VXX needs to decrease by 0.333% per day, and that is bullish for stocks. Right up until we get to the October expiration, the whole thing flips. The only way that this is possible, in my mind, is that the entire VIX futures curve would flip into backwardation at right after the October expiry, so into November election. That makes total sense into the election, expecting a lot of volatility, and VIX could spike up to maybe 35 area, and all the futures are now ascending to the VIX spot price instead of descending. So now VXX has a tailwind, and if you buy it, it has a guaranteed tailwind into the election. And that is in total agreement with the election year seasonality profile, with a big dump right before that October, or right into that October VIX futures expiration. One of the other things that I talked about, and what is a major holding that I had, was bonds. Bonds' normal 10-year seasonality does something very interesting, just like DJI, Dow Jones, election year seasonality, and that there is a big bottom somewhere around July 27th, a relative bottom that catapults into the end of August, and there is a huge rally, the biggest rally of the whole year. And I went heavily long into bonds because of this, and I saw a big breakout pattern going into the end of August. And notice that the peak in August is about August 31st. So for election years, that's a little bit before the peak in Dow Jones. And this is totally normal for bonds to peak slightly before the stock market. And that's the trigger. When you see them start to decrease and stocks still rising for a couple of days, you know that it's probably time to get out of the stock market and just go into cash or go into something else for protection. So this is one of the major things that I've been looking at going into the end of August. And if we look at bonds, 30-year bonds in particular, we can see one of the things that I was talking about in a couple of videos was that we had a big rally. We bought into this rally huge, and then this parallel channel that we're kind of traveling in, and I thought that we could have a matching move to this initial move here. I thought that we could match this initial move right here, and that I'm showing in this rectangle here, and kind of get up to the 184 area through this August move. And so far, it's playing out pretty well. We had a nice big, this thing looks like a huge inverse head and shoulders right here, where you can kind of see it. This guy right here, and did a big move up, and then kind of a retest back here where I was in the live group. We were buying the heck out of this area for a retest to go back up, and it looks like it was a huge volume day that day, so pretty nice. This is something that's definitely a great hedge for me with all of my long equity positions going into the end of August, first part of September. If we go back to the seasonality charts and we go back to gold spot, what's really interesting is that it matches bonds during this time of year as one of the best times to be in gold for the last 10 years. And I don't know if we actually jumped the gun on this huge move that it predicts into the end of, so it's a common theme, end of August, first part of September. Election year DJI, normal 10-year seasonality for bonds, normal 10-year seasonality for gold, all say that there's a huge rally for the month of August into the end of August. And I don't know if we kind of jumped the turnpike or jumped the shark or whatever on this. And I'm looking at these gray bars in the background that is actually showing XAU spot. I don't know if that was, kind of preceding this move, or we just catapult even higher, because I have plenty of ideas on TradingView for my TradingView handle that we're supposed to go to 2100 by the end of this year. And so far that's played out beautifully for the target, and my ultimate target is up near the 3200 to 3500 level, based purely on chart measured moves and a bunch of other principled ideas about where gold could go based on past reset instances like 2003 and 2008. Big resets like that just happened in March of this year, where everything got sold and nothing was safe, and everything got sold off, and then did the rally back. So I've gone over this a couple of times, and in the previous videos that I've actually done in the past couple of weeks, was we were looking for, if I can find it here, we were looking for this 2009 repeat of the dollar. And what this actually looks like is, if we look at 2009, and I'm showing both of these at the same time, both these charts. 2009 dollar, big sell-off. This is around the Lehman Brothers incident in late 2008, October 2008. Huge buyback of the dollar. Made it all the way to new highs, miraculously. Then the sell-off, which is kind of a 1, 2, 3 looking correction. Then kind of a long, whatever, like what it's doing. Consolidation to June 15th. And then this was the last opportunity to short, and a big short, and then a capitulation moment in late July, early August. A rebound into, mid-August, and then a gradual decline all the way to the end of the year. Here is fast forward to today. A much shorter version, but then did a realignment in June. Huge sell-off, the reset, everything got sold, including bonds, gold, equities, agriculture, everything. Then everything got bought back in order to raise cash. That's why gold sold. It doesn't make sense for gold to sell off, but it does if you're heavily long other things and your gold is the only thing profitable in your count. You got to sell it in order to cover your margin calls and other liabilities. Think hedge funds with billions that need to cover all their liabilities and not get margin called, and for some other reasons. But that's mostly what it is, to raise cash. So buyback, big correction down, bottomed on that ERS3 right there, and then I exclusively use the Camarilla pivots, and in the trading group you'll find out why. The Daily Edge Trading Group supports traders from, right now we have about 10 different countries in the group, and we all trade live around the clock. It's a great group of people. We've been around for about a year and a half, and it's been great, and we're killing it in the markets. This move back up into mid-June, remember, last opportunity to short, and then the gradual decline for the rest of the year. So that's exactly what we did for this cycle. If we look at DXY, and I look at the day chart of this, we did this huge capitulation moment right at the end of July, August. And what I blame this on is the FOMC statement that happens right at the end of July, early August. That's what I blame it on. And then the buyback. And this is a regression channel, meaning it's a best fit line for, I put it on this area right here. I can move it back one more. Actually, no, this is the high. This area right here, and I ended it right on the low, and it looks like we just hit this right on the low, and this is where I started shorting euros, was because of that. Actually, I started a couple of days ago, but I gradually kept dollar cost averaging short euros into this. Yes, it was painful. Yes, people thought I was crazy, that I told other people in like TradingView and some other friends that I have, and they were like, the dollar's just going to continue going down. I'm like, it can't go down forever, and there's definitely some pullbacks that are going to happen. What I think actually happens here is we have a nice retest of this same channel, this regression channel, maybe smack this March 2020 low from back here at the same time, and then follow that same 2009 profile and just continue kind of down, just kind of gradually float down and have another big capitulation moment. Maybe it extends. Maybe it goes like over here or something like that. I have no idea where it goes. Maybe it just keeps coming down all the way into, and then we kind of keep smacking this thing and then, come down into December, just like 2009. So far, the parallel is uncanny on how this is actually performing. And I am definitely a true believer in what's actually happening here. So, one of the things that I like to look at that I talked about earlier was the treasuries held by the Fed. And we are on a bond buying quest again. And what I like to look at is the assets held by the U.S. By the Fed, which is just the treasuries here. Not all assets, just the treasuries. Here's QE1. Here's QE2. Here's QE3. Here's repo right here. Here's QE4. So what I'm about to show when I go back to, if I go to SPX here, and I turn on this indicator that somebody in the group, Ari, made in the group, what this shows, and if I hide all the drawings here, hide these guys, all the moving averages, and we go back and I use a weekly chart, what I can actually show from 2007, in order to understand where my bias comes from. All of the movements of the Fed for all the 2010s and even now, the market is completely addicted to federal stimulus money. All of the major tops that have happened in the market have occurred around these federal, canceling or tapering or whatever of these stimulus programs. So if I go to, let me see if I can find it here. I've got it up on one of these charts. Here we go. So if I go to this chart, I have this annotated. This is one of the tweets that I did on Daily Edge Group. Just no dashes or anything like that for Twitter. This is a recent post that I did, and I'm showing the end of QE1, and in the bars in the background, you can see that there was a pullback. That was the 2010 flash crash that happened. QE2 ends. This is a right shoulder that you can barely see. If I go, let me see right here. Let me go right here. You can barely see this. Here is a head and shoulders top that happened. Here's the right shoulder of that head and shoulders top. This is a daily chart. This is right around where QE2 ended, and that's right where we had a 20% correction. Operation Twist is somewhere around here. That's when they started shorting the short end and buying the long end, and that's what killed gold. No other reason than that. It was Operation Twist in 2011. That marked the top of gold. Gold did not like that at all. And here is all of QE3. So you can see that QE3, kind of the slope of it, matches, kind of proportionally the slope of the movement for the stock market during that time. It ends, Stock market just goes sideways before finally having another 15 to 20% correction. And then here's the time where, the Fed started saying, oh, look, the Trump got elected and the stock market is going up and we're not doing anything. So we should just start selling our balance sheet while we can. That worked out for maybe 3 months, from October 2017 to where it got at the top. Big capitulation buying moment right here in the stock market. Huge capitulation buying moment. And if you go back to the actual chart here, when we look at it, that was a huge capitulation buying moment, and then the market just sold off. Here's where Powell capitulated to Trump, calling the bluff, and then the market started to increase rapidly again. Here's where repo started right there, and this is all of repo right here, this little segment. And then this huge segment is where the MBS purchases started up again with the Treasury buying, was QE4, and that marked the bottom of the stock market. You can see it almost marked it to the day where it actually started happening. So, what does all this mean? The slope currently is somewhere in between the slope of the Treasury buying is somewhere in between QE3 and QE2. I have not witnessed ever since 1998 a stock market top without one of these programs actually reaching a temporary top. And so far, that has not happened. And there's been given no guidance that it is going to happen. And the Fed gives plenty of guidance months, weeks in advance that it's going to end and that you should prepare yourself. And every single time, pundits out there say, maybe this time is different, the stock market continued to rise, even without Fed interference. And every single time they are wrong. So this is why I cannot be bearish on the stock market, because this is an active program and the current amount that has been purchased is greater than QE1 here, 2 here, and 3 here combined. And we'll probably reach 5 trillion by the time we get to the end of it. So that's something that I can't really go against. Another important metric is the high yield bond index. So this is kind of like the interest of HYG or LQD or something like that. So if you'll notice, for the past, every time there was a big move, so here's the end of QE1, here's the end of QE2, and the end of QE3 is somewhere around here in 2015. Every single time we have one of these major sell-offs in high yield bonds, which means that high yield, the actual yield, went to a really high level and there was a huge sell-off in the bonds. So that means that there was a huge spike in the actual yield. What this actually shows me is that it needs to kind of descend for a while before there's any kind of stock market relative top again, and it at least needs to get back down to the 5% level before there's any kind of big peak in the stock market. 5% seems to be the place that it needs to get back down to. Right bound around here was 5.54, 5.55 or something like that before QE1 ended, and then got down to 5% again here, 5% again here, and then stayed under for a very long time, which never ends well. But we haven't got there yet. We're still at 5, whatever we're at, 5.32 or something percent. So we're getting very close, but we're not quite there yet. And I definitely think that we have some more room to actually come down because of the length of, the timing of, when the next top of the markets would actually be. I don't think that we're there yet. Only 4 months after the reset event in March, I don't think we're there yet. So if you watched one metric, this would be a huge one to watch. And if you go onto the Fred app, it will show you some of the top most looked at symbols on Fred. And this is probably in the top 3. If we actually go to HYG and look at it, Just to let you know, some people have called this a hanging man. It could be, but this to me is a bullish pin candle, and we're going to accelerate through this and actually um, get to that February 21 gap by the time maybe at the end of this month, and actually fill this February 21 gap finally once and for all, after dumping underneath the beginning of the gap at the February 24th open. I think we can actually move, and it was a nice volume, highest volume in a month, it looks like, for S&P 500 spot. So just like we were talking about before with high yield, the high yield bond actual yield, these are the high yield bonds, and we just keep making new highs in this guy. And I have never seen a market top without this actually making a high and starting to fall off afterwards. So back in January, we kind of had a warning shot that we made a high in January, descended just with the stock market. So, decent correlation. We actually descended and then made a lower high just barely in February. Meanwhile, S&P 500 made a higher high, so a divergence there, and then started the rapid descent. I haven't seen anything like that yet. So while all the moving averages are moving together, I have to maintain the bullish stance based on the knowledge of the past and based on the Treasury and MBS buying programs. I just can't go against that. And at least up until September, which I plan on totally obeying the seasonality of the September top if it actually happens. It's still up in the air right now whether or not we're going to be 10-year DJI seasonality or the election year seasonality, which says that we should have, a big skyrocket up into the end of the month of this month. So until I see some kind of weakness, I really can't go against it. The Fed is still buying $5 billion a day in treasuries, and whatever it's doing, $1 or $2 billion in MBS or something like that per day. It's really difficult for me to actually call a top, because all efforts to call tops have been met with selling, except for this nice big retail-driven top on the June FOMC. That was a great short. Right away, it was a 5% return on S&P 500. Yield spreads running out of time was the next thing I wanted to talk about. So I have this chart that I look at that shows S&P 500 futures in yellow, and it shows all of the spreads, just the subtraction of the yield against the 2-year. So the 30 in the 2-year, the 10 in the 2-year, the 5 in the 2-year. What's down here at the bottom? Something else down at the bottom. The actual 2-year in purple. And what I wanted to show was that over time, you can definitely have a divergence in bonds being bought, which is the opposite of yields going down. It means bonds are being bought. Bonds are being bought. The Fed is buying bonds. So I expect bond yields to continue lower. This happened for years in the 2010 eras for QE1, 2, and 3, especially QE3, where bonds just went up and up and up, and stocks went up and up and up, and they're adding liquidity into the markets because when the Fed is buying bonds from the major banks and the dealers, they're buying bonds from them and giving them cash, which makes the bonds able to lend out more cash at lower rates to individuals and corporations, and small businesses can get all of these loans that the banks would normally not be able to lend them because it's not backed by bond treasuries, that the Fed is actually buying treasuries from these big banks, these big institution banks, and the big dealer banks. You can expect bonds to go up and stock market to go up at the same time for a while, but eventually the divergence can't usually last forever. So you can see the divergences in the yield spreads of the 30 and 2-year go down, down, down. Here is a good instance from the beginning of or late 2020 into February, and stocks going up, up, up. And then finally, this divergence creates a sell-off. S&P 500 going up, and bond yield spread for 30 and 2-year kind of matching, all the way up to this big peak in 30 minus 2-year, especially in the 10 2-year spread that you can see, and then a sell-off after that. And ever since maybe around here, and maybe for the 10 2-year yield, but especially for 30 and 2-year yield here, right around July 5th, this 32 spread kept going down and the stock market kept going up. I suspect that this is going to end maybe at the end of August, September, just in time for that election year seasonality to also end, and maybe we fill that February 21st gap around here somewhere, around 33.50 or something like that, and that would end right then. And everybody would be left confused, but we won't be confused because we're looking at all these correlations, and it's a no-brainer after you've seen this over time. The seasonality stuff really works, especially when you mix in the FOMC dates. It all starts to make sense, and everything starts to kind of align itself, and it's not just so random anymore. The people that are pulling the big strings of the stock market are aligning key events around these FOMC dates and around these seasonality dates, just like February. February and January are one of the biggest seasonal times of the year for the last 100 years of the Dow Jones for a big sell-off to actually happen. We knew about the virus all the way since November. Why didn't we sell off then? Because probably the people in the Wall Street actually called up their buddies. I saw this this Twitter post that you can tell what decade you're in when somebody asks you what's the hand symbol for a phone, and you're somebody like me that's at least 30 years old. When you ask them that, they do this, and then when you ask somebody that's maybe in their 20s currently and maybe is just getting out of college, they do this because they're used to their iPhone, or they do something like this for the symbol for a phone. I thought that was really interesting. Maybe someday it'll be something like this, and maybe when we get to Total Recall with Farrell or whatever, it'll be something like this where you got a phone implant in your hand. I don't know. Anyway, deviation. So, bond yield, the correlations with the seasonality is really interesting to me because I find it no coincidence that certain times of the year are scheduled for big sell-offs, and you can see that the 2-year yield was going down this entire time, and I guarantee you that high yield bonds, they had that little divergence here, but the 2-year yield was gaining or going down, meaning that people are buying 2-year bonds hand over fist, expecting near-term volatility before it finally gave up. So, and then it continued to go down all the way to the bottom. Meanwhile, 30-year bonds, 30-year the spreads skyrocketed all the way to the bottom. But guess what? I am in the firm belief that there are big Wall Street hedge funds and big Wall Street guys that phone up their media buddies at Bloomberg and CNBC and other, and whatever, and or Wall Street Journal, and they say, hey, we're positioned now. Go find us some bad news. It looks like this virus is probably some bad news. It's a real virus. It's real, totally real. But they timed the news release for maximum damage because it could occur in a February time where they could get the maximum sell-off that they actually wanted, that they were positioned for that sell-off. And it could have occurred a month, a week, before, but they positioned it at exact time where the news media could start cycling in this news. And I had a Twitter tweet that was just right before this in early January saying, you know what, this huge S wave is over now, and I think the one that I have on my Twitter profile, this guy right here, on the main profile, I have the pinned message that I have this huge S waves that I talk about, that I said, this way back here in November, I said, you know what, this looks like it's going to peak out and sometime right in time for the January and February seasonality time, that there could be a huge capitulation here. And I thought it could just come back down to this trend line right here, this guy, and just retest that. But I was totally unprepared for, and I thought it was around 3,400 would be the target. I was totally unprepared for the crash on the other side that went all the way to this low back here. But it's just funny to me how they managed to do this stuff, and it's not a coincidence. One of the things that I've been going over lately is the A50. And we have done a massive back test of a broken wedge that took 5 years to build. And we're at 12-year highs right now, so it's just a multi-year breakout on heavy volume and back testing this trend line. Potentially, we might not actually get there, but China is leading the way, and it's really important that emerging markets in China are actually leading the way. I suspect that one of the best currencies to be in for the next 3 years will probably be the yuan, and it's really hard to open a bank account that you can have denominated currency in the yuan. I know that there's something called what's the app that you can actually hold different currencies, like 200 currencies around the world you can actually hold it in. I'll try to find a link on it and post it in the actual information section of this video, but I definitely plan on doing something like that. I'll try to incorporate that in the video. But the Shanghai Composite is something really interesting too. And if you look at this on a weekly chart, oops, not Shanghai hotels. On a weekly chart, we're doing something like this trend line goes back to 2005, and this trend line has been tested multiple times. A little bit of a miss right here, but that's okay. We already got multiple data points on this. This is definitely breaking out, and it's breaking out from this big wedge from 2018 top right here, and it's accelerating, and all of the moving averages were consolidated in this area to move higher. So I was looking at somebody's video, I think, what's it called, a Game of Trades or something like that, his YouTube or something like that, and I was already on top of the China trade, looking at the fact that we could have another similar breakout to 2005-06 or 2014 into 15. It's very possible that we have something very similar to this, and the target would be somewhere up here at this 4,000 level. Something else on that video was that I did not know, but I will definitely use here to take advantage of this is I had something on here. I guess it took the drawings off that I had. Trading View's been kind of weird lately. This is the ratio of Shanghai Composite to S&P 500. And every time we get down to this level, it seems like it's been a bottom since 1994. And I suspect that the Shanghai Composite is going to outperform the SPX by a good amount. And it's possible that we have some kind of major breakout with these trend lines here. And I'm not sure if this is going to play out, but it could. And this could be a major breakout with these couple of points that we've actually kind of hit. And I'm just kind of drawing this triangle as a rectangle because it's not perfect right here. If I try to draw these trend lines, I just want to capture multiple trend lines. So this is something that I'm definitely looking at for a possible breakout, and and this is definitely some place to get into the Shanghai stock markets, whether it's A50, 8 shares, but mostly people do A50 for CFDs that are overseas. United States dwellers do not have access to CFDs. They've banned those. United States really sucks when it comes to Forex and CFD trading. If we go to the DAX, one of the important things to look at is the fact that we retraced this 2007 high. They were both kind of in the same place here, and this massive retest that we had, and we're still going higher. So I definitely think that this was just such a huge reset moment that we can definitely move to higher territory. Is something I'm looking at, I've been looking at, and it's just so hard for me to call any kind of major market top when all of this stuff is happening, and all global big countries around the world are doing massive stimulus. Fed is doing 350% times the ECB, and I talked about this in a couple of tweets that I did and in a couple other videos that I have some graphics on this, and that's why the dollar, I think, is slated to continue its descent against the euro towards the end of the year. If we look at the yen, on Friday we had a huge short covering rally right on this year Camarilla S4, and I went long yen futures heavily here and anticipation of what was actually going to happen. And I'm okay being against the grain here on this, because I have a feeling that yen is going to continue to decline after we do one of these type 2 Camarilla trades that I talk about. After striking an S4 and back to S3, it's very possible we could come up to here and then keep descending, and the target would be somewhere around this March low, just like the dollar did. But this is what I think. One of the things that I was looking at over the weekend was this Rambus guy that I did a link on his public content that he released. And one of these things that he looked at was comparing the XJY, which is only on stock charts. That's the yen. That's not USD JPY. It's the opposite. It's the yen. In this huge wedge, and the correlation between it and, so this is just yen, like yen futures, the correlation between it and the gold bugs index, HUI. Big top right around 2011, and then the bad years, huge bottom all the way into 2016. That's that big commodity bottom where it's time to buy. Big rally, retracement, all these points are kind of lining up a bit. And then this huge area, which is really important down here, huge retest of this rail at the March bottom this year on the reset of everything after touching the top up here, and then coming back up with a massive breakout, and then the back test, and then the further highs. And you couldn't ask for a better pattern. It's just perfect. It's absolutely perfect for gold miners and to keep going higher. But you'll notice that the yen has not really caught up to this in the same way. So one of the next picture was showing the fact that the yen is the gold bugs index is greatly outperforming the yen currently, and this can mean one of two things: either gold bugs index and miners themselves, gold miners, have just gotten way ahead of themselves and they need to retrace to recorrelate with the yen. And you can see that the yen is super correlated with the gold bugs index. Or what my idea is, because I just don't think that's even close to being possible, the yen is the thing that needs to catch up with the gold bugs index. And you were looking at the RSI of XJY of the yen, and it looks like it's in, even RSI is showing that it's in a mid place here, and the thing that it needs to do is get up and touch overbought up at the 70 area and complete the move. So I'm okay being long yen futures and short the yen, short USD JPY. Gold and bonds heavily correlated, no surprise there. One of the huge things that I was looking at earlier was the fact that this chart right here is showing the difference between the yields of Japanese bonds and US bonds. This is USD JPY in the background in orange, and this is showing a huge sell-off in this yield, which to me is, I definitely agree with this analysis. and that the yen is due for a huge move up, meaning that bonds go down, yields go down. So definitely in agreement with that. 5-year tips. This is Treasury protected bonds, and the correlation is uncanny with gold. The same, you can see the same chart with 10-year bonds and gold, and the bonds are going up and gold is going up too. And we're definitely in a seasonal moment right now for bonds and gold, that we can actually have a huge move to the end of this month in August, and that's kind of what I'm looking at for gold miners, and I don't see why not. I mean, 2009 seems to be correlating extremely well with many different asset classes. I have to, and I am going to continue to think that, based on the moving averages and based on everything that I've been talking about, that everything looks bullish, and I consider the fact that we're going to probably approach this February 21 gap very soon. But I'm protected. I'm long equity futures in ES and NQ, so S&P and S&P 500 and NASDAQ futures. I'm long bonds. That helps protect my stock positions in the near and long term, and those are gaining money because of a bond buying program. And the Fed has shown no sign of stopping. And long gold, got short euros for a little bit because of what we were seeing in previous years. Remember the DXY that I showed in the previous chart definitely showed the fact that we can have a big bottom somewhere at the end of August or the end of February, early August. And that's right where it lines up with this channel and right where the Fed happens. So I blame it on the Fed. I blame it as DXY selling into the Fed and stocks getting bought into the Fed, and probably some kind of a retracement afterwards. Same thing happened in 2009 also, after the big reset moment that we had. I'm in total locked in with the fact that I feel like 2009 is going to be a repeat for DXY and other currencies. And, so far, S&P 500 has reacted negatively to any dollar rallies. This was definitely true from 2009 all the way to 2015. Every time, 2014 was a big dollar rally. The stock market continued to go up, but years before that, any kind of dollar move up was negatively impacted the stock market in the short term. And that's definitely what we're seeing now. Every time we have a dollar going up, it seems to negatively impact the stocks, except for on Friday. And so, it's all about having protection and multiple ideas here and multiple things running together, maintaining a view, but the right view of where things are actually going. So I can't ever be fully long stocks. I can't ever be fully long gold. I've got to have other things going on. For a lot of this run, I was definitely super exposed to gold long, but that's okay because, I got in good positions and I took profit along the way and then got back in. So it's okay because I was maintaining positions that I got in at good prices, and I didn't need to have the risk averse assets in a portfolio to deal with any kind of mega drop in gold or something like that. And it was just bias and experience dealing with these types of market environments over the past that made me go long gold and silver over the past couple of videos that I've done, just nailing these things on gold and silver that we've done in the group. So definitely come and join the Daily Edge group. We've got traders from 10 different countries, and we've just been killing it in the markets, and we've got a lot of different great opinions that with the right mix of opinions with people live trading these kind of markets, we can navigate and all make money together. We're all using the same strategies. We're all using the same ideas, and we're all kind of on the same page, shooting stuff back and forth with each other to make money in one of the weirdest and hardest market environments that I have ever seen in trading. And it's definitely been a challenge, but it's been a lot of fun. but it's been a lot of hard work, a lot of late nights trying to maintain these positions and maintain the confidence of where the markets are going. And you can't do that without a rock solid group of individuals that are trading with you so that you can shoot ideas off of each other in real time and make all the call outs in real time of all the trades of when we're going in and then out and why and where the targets are and what we're actually doing, and seeing all of it play out, day after day, week after week, month after month. We've just been killing it ever since April, making all the major plays in all the major asset classes that people care about, mostly in futures and Forex, but a lot of stock trades also. The last thing that I'll talk about is I wanted to go into Apple stock that made a huge move this last week. In all the videos, I definitely talk about Daily Edge Live, and one of the products that's on the main website that's always linked in these videos through www.daily-edge.com. Daily Edge Live advertises this product for getting all of the dark pool blocks and block summary of major trades for any symbol out there. And over the past, if I go to the past 5 days for Apple, you can see that there was this huge 2.1 million block trade in advance of earnings after this big correction level that we had, or this big correction in advance of earnings, and just skyrocketed after earnings and just blew past this previous level. And we're now 13% above this block, which is being shown right here. So one of the assets that we have in the group, and part of the subscription of being with the Daily Edge, is that you have access to a huge amount of information for block trades and getting all this stuff on the fly and getting where the current price is relative to the blocks, translating blocks into, if I wanted to do the index or just an individual symbol, I can do index, but I can translate it into futures, and I can do the last 2 days. And instead of getting SPY, QQQ, and all those things, I can do the index futures translation for the equivalent level in like ES or NQ or YM. Same thing for something like CFD. So I can do index CFD for SPX 500, NAS 100, all that kind of stuff, and get the last couple of... this is just from Friday, by the way, but what this is showing is that we had a ton of live blocks and SPY, and we had some dark pool blocks, some same day late blocks. All the dark pool blocks are shown in with a dot next to them, and this one is from the Thursday close. All of the late dark pool blocks that showed up on Friday, and we ended up closing above all of them. And Dow Jones did very well. NASDAQ also did very well. So closing above all those blocks, closing above the S&P, the SPY key level, that is this 40 million level that we've been bouncing around. I've got to maintain that bullish bias as long as we keep doing this. And the next target would be up here at this 20 million level, back from January 20th at 332 or about 3320 S&P 500. So Daily Edge Live is extremely useful for just getting all of this background information on what the big money and the smart money and the institutional buyers are actually doing in the stock market. And it's just been a major asset to see these big blocks that happen during the day, and knowing that they are most likely turning points during the day for the stock market. You'll see these big blocks come in, and we'll show them, and we'll talk about them, and we'll see the price immediately react to them, and we'll say, you know what, that looks like a buy block. It's on some pivots. It's on some other important support or resistance levels. We're going to go in long based on it, and it's just been absolutely great. It's just a well-oiled machine what we're doing here, and I recommend anybody join the group and come on board. That's all I'll talk about now. It's about 40 minutes till futures actually open. Forex is already open. Check us out on the website that's located in the information section. Check us out on Twitter. Um, uh, any questions? Telegram is a great contact location if you want to contact me personally. TradingView is the same handle. More Diggity on TradingView or on Telegram. Okay. Good luck this week.